Hi traders, welcome to Market Outlook, Trends, Risk Events and Trade Setups brought to you by Vantage Markets. This is a weekly webinar where we focus on the key events and themes, both fundamental and technical, driving markets at the moment. Whilst I just let you have a look at the disclaimer, which you can just briefly browse, it's another exciting week really in markets, especially for FX market stocks for sure, before possibly trading conditions start to wind down for the summer. The spotlight will fall, of course, on Wednesday's latest US inflation report, which could help the dollar or underpin some support for the dollar and potentially future Fed rate hikes. Central bank meetings we get, of course, this week as well in New Zealand and Canada. New Zealand expected to stand pat. We'll look at that. Canada, more of a tough call, actually, close call, around 2 and 3 chances of another back-to-back 25 basis point hike by the Bank of Canada. That is what's priced in by money markets at the moment, and we'll run through that later on in the webinar. Generally, I think I like this chart at the moment. Gives us a good picture. If we just step back, always like to look at a sort of wider theme. Most major central banks anyway recently have moved to this data-dependent stance. Of course, for some of them, this translates into a pause or skip or some other similar type of term, if they even categorize it, but it is a skip before then reassessing data, assessing the impact of all this previous policy tightening on inflation and on growth. But if we just think about the US, that data recently especially is interesting, of course, as there has been this skip, but the data has been especially strong. And the overall sort of tone of that data so far, especially say last week, is pretty undeniable. So we had ADP, which was really strong. We had weekly jobless claims, which weren't as high as some of the highs in previous weeks. We also had the ISM services data unexpectedly jumping to 53.9 from that sort of boom bust level of 50, and as well. Certainly, of course, we had the non-farm payroll report, which was lighter on the headline number. We did have those downward revisions. We'll look at that in more detail, but also we had wage growth, which was still fairly strong. But just this chart just is basically the US Economic Surprise Index kept by an investment bank, Citibank, which tracks how much incoming data is exceeding or lagging expectations. And as you can see, that number has jumped to the highest in more than 2 years. So just something to bear in mind. It's interesting. We're getting a lot of outsized data prints, really, and whether that can continue. But certainly, it's interesting that then there is this idea that then the US economy has kind of gone through a temporary dip. And certainly then with the solid labor market as well, that's putting a strong flow for demand. In this scenario then, all in then, if you think about it, the central bank's wait and see sort of pause, if you like, has only kind of lost some time in their attempt really to bring inflation back under control. And what we've seen certainly in bond markets is a big pickup in yields. If you look, and I don't want to get into this in too much detail, but you look at, say, the 2-year yield, which is this one, the 2-year treasury, sorry, that's a 10-year, 2-year treasury yield. We've highlighted this before. Actually, you could see this is the weekly chart. You can't really trade this unless you're a fixed income trader, really. But for us, it's a good guide for obviously where rates are going in the 2-year space. And you can see we're back to above, well, we briefly posted above 5% and back to March banking crisis condition, levels really above 5%. And then you can see that sharp drop because of the issues that this very strong hiking cycle that we've seen over the last 15, 18 months or so has had an effect on certainly the regional banking sector in the US. So just to pause there, you can see really interesting. Last week was a doji candle, so that does denote some indecision at the highs. You can see it posted a new high at 5.11%. This is the 2-year treasuries. That closely maps Fed funds futures. If we just look then at the 10-year Treasury, that's kind of a proxy for global borrowing costs, if you like. And you can see that pushed above 4%, so a key psychological level. And it's just around this previous year-to-date high, which was at 4.08%. So interesting levels for these Treasury yields, and whether then they're going to cause some issue, well, in the economy, of course, but then also for some other markets. And we've seen a rise in real yields. So real yields are these nominal yields less or then you deduct inflation, and those have risen as well. And that's triggered certainly this setback that we've seen, slight setback that we've seen in stocks and in the S&P 500. As I said, whether this continues is key for markets going forward. Interestingly for us, just before we look at the technicals around the S&P, you can see the dollar didn't really respond. So really interesting rise in real yields, rise in nominal yields, but the dollar didn't really take off and move up to the upside. So yeah, something to watch out for here, and especially with US CPI on Wednesday. It kind of, for us, if we're thinking about the dollar anyway, should it put it in a kind of solid position? Interesting, and we're wary that it hasn't responded to that firmer data, really, the dollar, and the markets are still unconvinced that the Fed do 50 basis points in total, actually. So the July meeting is nailed on. That is a 92% chance, according to Fed Funds Futures, the CME Fed Watch tool here. You can see the 26th of July is the Fed meeting, and this is priced at 92%. So nailed on 25 basis point hike, but it's further out that is interesting for us and for the data. So you've got sort of a 38.5% chance that we get another 25 basis point hike by or during that 1st of November meeting. Only 2 more meetings after this one in July in a few weeks. And then if you say, look at the December, you can see then we're getting into sort of peak rate territory around then. And then we're obviously not looking at rate cuts anytime soon, according to the Fed at least, and the market is sort of backed off that pricing, as we all probably know. Yes, let's just look now at the S&P 500. This is, let me just pull it up. Yeah, the weekly chart, and we've gone through this. We always go through this over a number of weeks. You can see that push up above sort of 4,200 that we've highlighted. And we're getting sort of quite high on the RSI, so sort of slightly overbought territory. Nothing major, though, so we can go higher. But we have pushed off. We'll just come back off that high, which is at 44.58. Strong support, we'd say, around 43.11, this fib level here, and then the upside sort of level would be probably 45.34, that minor fib level, and then potentially 46.37 if we can break that high at 44.58. NASDAQ, similar kind of chart, just holding at the highs, just pulled off there. If we look at, the next fib level is 15.411, and then probably I'd say the first breakout level is probably this low around 14.571 as support. And you can just see on the daily, if I take off these count the channels, then you can just see hovering around the highs. As I said, well, that low probably is better support, 14.687 for us, which is kind of just above that breakout level you can see there. The Dow, really interesting. I hope you guys have been following this last week, especially when we have consistently highlighted this strong resistance level, 34,281, capped the upside numerous occasions over this year and just before November, December, you can see. And we failed again. Previous week, we did close above it at 34,407, but you can see we rolled over. A few days of declines, and again on Friday as well. So we're back to this support level, which looks probably pretty decent near term, at least. Held the downside late June, so that's at 33,651. That's the 50-day moving average. Below their 100-day moving average at 33,370. If that does support, then again look at 34,281 as resistance, and we'll play around with it, which we have done over the last few months. So really interesting there. Whether we try and take it on again, or we roll over a bit further below this near-term support at 33,651. Okay, that is stocks. We'll now just briefly touch upon the non-farm payroll. This is just the graphic. We had a preview before in this graphic. Now we've got the review, if you like. Friday non-farm payrolls figures, certainly the headline, so that missed expectations at 209,000 in June from 306, so that was revised down from 339k in May. And that was versus the median forecast of a June reading around, it was around 230k. Interesting, if some of you delve deeper, the whisper number, so that's sort of taking into account a lot of the week's data, and certainly that strong ADP number, that was up around 270k or so. So yes, the first undershoot in 15 months by for under expectations. So a rare event. We highlighted that before, 14 months of beating headline numbers. But then we also had, as I said, two revisions to two previous months, total net downward revision of 110,000. So very significant downward revisions, as I say. Private payrolls as well. We haven't put that on here, but they rose only 149,000 versus 200,000 consensus expected in June. And that was versus 259,000 in May, revised down from 283. So that is actually the weakest private job gains since December 2020. So just something to note there. However, unemployment, well, that ticked up 2 ticks, 2/10, sorry, to 3.6%. And then we had average hourly earnings still elevated, a gain of 0.4%, although actually the rounded number was sort of closer to, well, spot 3.5 really is spot 358 if we're talking about decimal places, but the year on year was still high, 4.4%, and that was above consensus estimates of 4.2%. And this was despite a plus 0.1 uptick in average weekly hours. So yes, this is the pricing. As I said, we've just touched on that actually, and the sort of near coin toss chance of another 25 basis point hike by that 1st of November meeting. That came down slightly on the slightly softer data, down a sort of 39% chance now of that next 25 basis point hike after the one that is nailed on, as we said, and we showed you in July at 26th of July, a couple of weeks time. Okay, we also had, in fact, we've got a chart here. We had this last week actually, but it just shows you where we are currently around that 200 mark or so. We printed on Friday, unemployment just ticking up to 3.6, but as we said, still low. 3.4%, if you remember, is actually a multi-decade low from 1969, and we then printed that in January. So 3.6, couple of tenths off, but still very low. The Fed believe that this will get up above 4% towards 4.5% by the end of the year. So really key number that is for policymakers, and whether the slowdown, whether they're policy hiking, affects eventually this really resilient labor market that we're seeing. Certainly in the US, not only in the US, actually elsewhere too. We also had, just moving on then, the ISM data for services, especially, which kind of was very strong. That confirmed, well, the employment component, which had dipped below 50 in the previous month, is now 53.1. New orders rose. And the overall index, as I said, I think 53.9. So a touch above then that 50 boom bust level. They're not particularly high readings, we have to say, but importantly, they are reversing some of the declines that we've seen in previous months. That's key. And prices paid also eased actually lower. If we're getting into the detail, that eased to 54.1. That is encouraging, and certainly if you think the long run average for prices paid is around 60. So what we've seen, market yields, as we said, they was kind of comforted by a calming implied inflation expectations, but at the same time, certainly concerned generally with this macro strength in services for sure. And that will probably frustrate ambitions to get inflation materially lower in the coming months. And really that tendency, as we showed you, for yields to stay quite elevated. Okay, that's US data from last week. We also had the RBA, which, if I just pull up the chart, bear with me 1 second. Well, the Aussie dollar chart, at least, which has tumbled today. The RBA, they kept rates unchanged at 4.1%. It's the second pause this year after keeping rates stable in April. And then they implemented back-to-back rate hikes in May and June. So just bear that in mind, obviously, with this pause. Some further tightening monetary policy may be required, the board said, to ensure inflation returns to target in a reasonable time frame, but that will depend upon how the economy and inflation evolve. The decision to hold rates steady this month actually buys time. Kind of touched upon this. This is what the board said as well, to assess data and associated risks. And growth, we have to bear in mind, growth has slowed in the economy, in the Australian economy, and conditions in the labour market have eased, although they remain very tight, and wage inflation is still strong as well. So while inflation may have passed its peak, it's still too high and will remain so for some time yet. That's probably our key takeaway from what the RBA said. As for the Aussie dollar, well, it's a bit messy, isn't it? You can see we've got this sort of long held range. We've got sort of below 66, above 68, that sort of range. We broke out of it, down, couldn't really sustain that, and again to the top side not long afterwards. So we're again sort of, playing around with these simple moving averages. The blue one is the 50-day, the grey one there, upside, the top one, 100-day, and then the black one, 200-day moving average. Probably capping resistance, acting as resistance, capping the upside, you can see. So 66.96 is that 200-day moving average. And then we would say sort of near-term support before the sort of lower of the range is probably where around 66 actually. So look for that to hold or potentially go below, but just watch out for a false break, I guess, over the following few days, potentially. A lot to do with China, of course, and the Aussie is suffering, as you can see, floundering really, due to that softer than forecast Chinese inflation data we had, which prompted actually more speculation about additional stimulus or impetus overnight. So that's the Aussie as we see it, taking a tumble today, at least. If we get on to this week's data now, firstly, let's look at, just bear with me 1 second. Before we get on to US CPI, we'll look at UK data, really important wage data coming up tomorrow. That's with less than a month to go, actually, until the next Bank of England meeting, which is on the 3rd of August. So after, it's the week after we get the Fed on the Wednesday, ECB on the Thursday, Bank of Japan on the Friday. That's the 26th, 27th, 28th of July. And the following week, 3rd of August, we get the Bank of England on the Thursday. So whole heap of big risk events coming up end of July, and then that Bank of England meeting start of August. But they'll certainly, policymakers on the MPC, be watching regular pay growth, average earnings, that is, excluding bonuses, which is out on Tuesday morning. Yep. That picked up recently. And the question really is whether that is down to, well, a genuine increase in pay pressures, or possibly firms in the UK here implementing this 10% increase we've seen in the national living wage. Consensus expects to see, well, the unemployment rate unchanged, but it's all the focus on the wage data and remaining high, probably that consensus number around 7.1%, 1/10 below the prior 7.2%, which sparked a very strong, really hawkish market reaction. As for money markets, they price in around 44 basis points of rate hikes for that August meeting. So potentially, probably another 50 basis point hike. If this wage growth data is strong, or certainly if it surprises to the upside, then that 44 basis points will probably move above or towards, for sure, a half-point rise in August in a couple of weeks. And then at the moment, there's a total from the 5% mark where we are, around 145 basis points in total. So a peak terminal rate very close to 6.5% in the UK. For us, that kind of leaves quite a lot of room for dovish repricing to hit sterling potentially, should the data surprise on the downside. And we also get, let's not forget, UK CPI, which is next week, the 12th of July, which again will be the last piece of important data, apart from this wage numbers, for the Bank of England and their meeting. Sterling, this is the chart. You can see we failed look at resistance at the previous highs at 128.48. We're just turning lower. Where do we get to Friday? 128.49. And if you look on the weekly, it's interesting. We closed on the highs, but on that resistance level. And then you can see the black line is the 200-week moving average. That's at 128.86, so just above as well. But 128.48, the previous high, just closed above, but sadly, we've just pushed lower now on the day today, down close to nearly 0.5%. So interesting level there, for sure. Probably support 126.80 around that level, which tallies with this sort of push higher as well. That will be initial support for us. Before then, well, the 50-day moving average is just below that sort of swing low at 125.91. So that is cable sterling. Let's get to the marquee event now, which is for sure UK CPI. You can see the chart here. Headline then is expected to have slowed meaningfully in June, but core inflation is likely to remain robust, giving, well, the Fed further incentive really to resume that hiking path at its July meeting. You can see then, hopefully this is clear, the orange line is the falling headline number. We've put in here as well on this chart anyway, is services less shelter. So that is something the Fed look at, the red line, and then you can see core CPI, the sticky CPI number, which excludes volatile food and energy, is more sticky and not falling as sharply at the moment. CPI headline anyway, that is driven by base effects. We put this out in the week ahead actually, which we put on the website. Base effects essentially mean they compare the reading with the 12 months ago. And if you think we had hot CPI readings from June 2022, they'll now be dropping out because of the 12-month calculation. So we're not comparing ourselves with that sharp spike that we saw previously just over 12 months ago. So that's these base effects bringing the headline inflation lower because of energy costs coming down sharply. But the core, as we said, is key for policymakers. And that's expected to be at 5% year on year, so just below the previous month's rate of 5.3%. That's remained stubbornly high, as we've said, even as the headline figure comes down. It's likely to be more important for the policymakers, as we said. A core reading, of course, if that's higher than or falls in line with economists' expectations, that really cements that 92% chance of that hike for sure. But it's then whether it pushes out, or not pushes out, but sort of the chances of a hike then in September, November increase if we do get a stronger core reading. We like to think that as well, the month-on-month reading, if you remember, expected at 0.4%, I think, but economists generally reckon that's got to come down to around 0.2% to bring then the year-on-year number back to the Fed's target at 2%. Okay, that is the US CPI data. If we just look at the DXY, which is kind of the inverse of euro dollar, I've said this before because of the strong heavy weighting in of the euro in the DXY, you could see that plunge really, strong move lower after non-farm payroll, but we're now on support, which is the June lows around sort of 102, 101.92. So that should offer initial and quite strong support there because it held up prices. You can see held up prices through June. If we do break lower, then certainly we get to 101 and 100 spot 82. Otherwise, these are the 50-day and 100-day moving average may offer some resistance. You can see around 103, just below 102.98, 102.92. That's the DXY. Okay, finally, let's move to dollar CAD. We have the Bank of Canada meeting. Probably more important than the RBNZ. We'll touch upon that if you like briefly afterwards. But yeah, the BOC is, well, consensus looks for a 25 basis point hike for the second straight meeting. on Wednesday. That would take the key rate to 5%. In fact, let me just get the graphic first. Just done a graphic for you. Hope you like these. Just puts out the sort of main numbers that we see and that probably policymakers are looking at. So 25 basis point is consensus estimates, expectation. It is a tight call, though, with economists split actually between then a hold and a rate rise. Markets, I think, as I said, around a 2 in 3 chance, so 67% implied probability that the Bank of Canada hikes, so not a 33% chance that they don't hike. So something to bear in mind. Could be volatility, certainly. Recent inflation data that showed a significant decline in price pressures in the headline rate, at least 4.4 to 3.4%, again due to base effects. But let's note the Bank of Canada does not see inflation returning to its 2% target until early 2025. We still have sticky core rates of inflation, which, sorry, I'm drumming on about, but are important, of course. We have decent GDP actually, coupled with then this still tight job market, suggesting the economy remains pretty sturdy. And we had that 59,000 job gain figure on Friday, beat that 20,000 and sort of reverse the trend for lower job gains, well, from the previous month at least. Also, yeah, just on the plus side, really, half full side, if you like, for the economy, is more persistent momentum in consumer spending, as well as we just touched upon, that labor demand. The key question then is when we're going to see kind of a material slowdown in labor market conditions, as well as the economic outlook. I think there's a Reuters poll which finds that analysts are more split on the prospects of a recession. And ahead, analysts think after the July hike, the BOC will likely keep rates unchanged well into 2024. So interesting that, and that could be we could see some volatility if the BOC is still hawkish or not, or whether this is kind of, we get a 25 basis point hike and then a sort of hawkish pause commentary type thing. Yeah, that's where we are currently, 4.75%, 22-year high. And yes, could be some volatility around this meeting on Wednesday afternoon UK time. As for the currency, you can see, well, we broke above that previous low, which we had dipped below. So we broke above 132.62 on Thursday last week sharply, but then reversed that, which is actually the halfway point of the June fall. Actually, the halfway point is at 133.84, as well as actually the 50-day moving average as well at 133.84. So that is definitely resistance, and then support 132.62. Otherwise, we go lower to sort of 132 and potentially then down to 131 if we lose that. That is the Bank of Canada. Okay, I don't see any questions at the moment. Somebody says, can you look at GR30? I presume that's the DAX 30, is it, further? If you can confirm that, that would be good. Just briefly. Otherwise, yeah, let me know if that's the index you want to look at. Yes, the DAX. Good man. Or good person. Right. Bear with me 1 second. Yeah, we look at the DAX. We have looked at it before, actually, and not looked at it for a while. Bear with me 1 second. This is, well, yes, the DAX. Hopefully this is the one you refer to. This is the one I look at all the time. It's the one we have, I'm pretty sure, in full vantage. You can see, so yeah, the highs we've sort of stumbled around, haven't we, above sort of 16,000, 16,427 was the high. And we're just sort of moving now below potentially that 100-day moving average. Interesting. I'm just seeing how has that acted as support previously. So it did act as support around here. And then we just lost it again, but we sort of a couple of days trading around it. So 15,717 for me is support resistance for sure. That sort of tallies as well with this sort of cycle swing low, if you like, at 15,629. If we can push above there, then again, we're back into this sort of range, and 15,965, probably another upside level to take account of before we can push on above 16,000, I'd say. If we do lose Friday's low, which is 16,456, then potentially, where are we going? We're probably going to, where's the next sort of swing? That swing there, we're probably going back to sort of, I'd say around 15,000 potentially if we lose 15,456. Hopefully that's helpful for you. DAX performed very well. We touched upon it last week, actually, or the week before. Strong sort of performance in the first quarter. Not really buoyed by China, but has done well, up around 16% from memory in the first quarter. But then, as we can see, just struggling at those previous highs, around 16 and above 16,000. This is a weekly chart. As I say, a few levels to watch out for on the downside, but Friday's low key. Before then, we would get down towards potentially 15,000 or just above. Okay, hopefully that helps. That is all we have time for now. We've covered quite a lot, as we always do. Hopefully that's proved useful to you. Please do follow us on social media. We do post a daily commentary as well on the website, which has a chart of the day and look at the day ahead, otherwise market thoughts. Okay, please, we look forward to welcoming you back same time next week, and we'll be reviewing all this data as well as looking forward, of course, to UK CPI next week. Okay, take care out there, and we will speak to you soon.